In today's episode, I will analyze Intel, a leading semiconductor company that has been struggling in recent years. One of the factors that set Intel apart from its competitors was its ability to uphold Moore's law, which states that the number of transistors on a microchip doubles approximately every 2 years. Unfortunately, Intel has been unable to keep up with this trend lately. Additionally, Intel has been facing intense competition from rivals such as AMD, which leveraged TSMC's strength as the world's leading foundry to build industry-leading CPUs. The rise of artificial intelligence has also unleashed a new competitor in Nvidia for specialized chips to accelerate AI-related workloads. Consequently, Intel is now running behind its biggest competitors. This is evident in the loss of market share and the significant decline of over 50% in its stock value over the past 2 years. Does this mean that we should dismiss Intel stock? Stay tuned with the Finance Dude. Hey dudes and duderinas, this is the Finance Dude. In this episode, we have 2 missions. First, assess what's happening with Intel's business for such a crash in stock price, and second, assess Intel's valuation. As always, I start this first approach with the 5 dimensions method. And the first dimension to be analyzed is the growth dimension, where I will start with Intel's revenue growth. And what we see here isn't nice, dudes. After experiencing reasonable growth from 2013 to 2021, Intel's revenues took a nosedive, plummeting nearly 30%. This is a clear indication of the disruption the company is facing. However, it's too early to completely dismiss Intel. In an effort to turn things around, the company has taken steps towards restructuring and refocusing. They've brought in a new CEO, Pat Gelsinger, who is a veteran in the semiconductor industry. Gelsinger has pledged to invest heavily in research and development, and to make Intel more competitive. In line with this commitment, Intel plans to invest billions in new manufacturing facilities, with the goal of utilizing 7-nanometer chips by 2023. While these initiatives are promising, for now, we'll give Intel a rating of 1. Moving on to net income growth, after 4 years of record profits, Intel has experienced a sharp decline, resulting in a negative net income of $-2.85 billion. This is the result of the loss on market share, the consequent need to concede in pricing, and the increase on investments aimed at improving again its overall position in the semiconductors market. Given these circumstances, rating of 1. As you can see, the same happened in free cash flow growth. However, instead of a loss in accounting profits of $-2.85 billion, Intel suffered a staggering loss of $23 billion in cash over the past 12 months. This looks scaring for Intel. Again, a rating of 1. This is definitely not a good start for Intel. Now, let's move on to the second dimension of our analysis, profitability. Let's start by examining the gross margins. It's evident that the loss of market dominance has significantly impacted Intel's margins. Previously averaging around 60% until 2020, their gross margins have now plummeted to 38.3%. This sharp decline is clearly a cause for concern. Just take a look at Intel's income statement. While the cost of revenue remains stable, the decrease in revenues amounts to almost $23 billion. This is an alarming trend, warranting a rating of 1 in this category. We can see the same in operating expenses. Not only the SG&A expenses stayed at the same level, but the expenses in R&D have surged 27% while revenues have declined nearly 30%. This combination paints a bleak picture for Intel. Examining the operating margin, we see a distressing decline. Consequently, a rating of 1 seems appropriate in this metric as well. Unsurprisingly, the same pattern emerges in net income and free cash flow margins. Just look at Intel's current free cash flow margin, -40.9%. Wow, rating of 1. Lastly, in return on invested capital, we observe a similar trend of strong profitability until 2021, followed by a significant crash into negative territory. Rating of 1. Now let's proceed to the third dimension of the analysis, solvency. In quick ratio, we see that the current assets are sufficient to cover all the current liabilities, indicating a healthy position. Therefore, I give a rating of 3. Moving on to the debt-to-equity ratio, despite the increasing importance of debt in this ratio, a current ratio of 0.5 is still considered very healthy. This suggests that Intel is not excessively leveraged, warranting a rating of 4. Unfortunately, the positive performance observed in the solvency dimension is not reflected in the debt-to-free cash flow ratio. Due to negative cash flows, this ratio receives a rating of 1. However, it's important to note that if Intel manages to turn the business around and improve its performance, we should not encounter any significant issues in this ratio, as the level of debt is not unsustainable. It's time to move on to the fourth dimension, valuation. Starting with the enterprise value to sales, we can observe that Intel is currently trading below its 5- and 10-year averages. This is not surprising, given the challenges Intel has been facing in its business. Obviously, the market's interest in investing in stocks like this isn't as strong as compared to the hottest stocks of the moment, such as Nvidia. However, it's important to note that situations like these, where stocks are trading far below their average multiples, can present great opportunities for investors to achieve returns above the market average. We have witnessed similar opportunities in stocks like Meta Platforms and Tesla in the past. These stocks seem now overvalued, but those who bought them during their lows at the end of 2022 have enjoyed outstanding returns. However, the current situation with Intel stock does not appear as favorable as it appeared to Meta and Tesla at that time. Given the comparison of the current multiple with its averages, I rate this metric with a 4. Moving on to the price to free cash flows and price to earnings ratios, since Intel is not generating positive cash flows and profits at the moment, these ratios are not applicable and restrict the applicability of these valuation ratios. Therefore, a rating of 1 for both. However, there are projections indicating that Intel will return to profitability next year. This can be observed in the forward price to earnings ratio, which utilizes forecasts of next year's profits instead of current profits. In this ratio, despite the positive sign of the expected return to profitability, the projected profits still appear to be minimal, as indicated by the current multiple of 74.62x. Taking all factors into consideration, I rate this multiple with a 2. Lastly, let's delve into the fifth dimension of our analysis, dividends. Examining dividend growth, we observe that one of the key actions taken by the new CEO, Pat Gelsinger, was to reduce Intel's dividend payments. This decision aimed to redirect the cash towards improving Intel's business. Gelsinger implemented a 65% dividend cut, reducing the dividend from $1.46 in 2022 to the current 50 cents. Previously, Intel was paying approximately $6 billion in dividends each year. With the reduced dividend, I now anticipate annual dividend payments of around $2.1 billion. This reallocation of capital can be viewed as a positive move if it leads to the restoration of Intel's dominance and growth. However, solely from a dividend metric standpoint, I must rate this with a 1. Similarly, the dividend yield exhibits a comparable trend. Over the past decade, Intel's dividend yield averaged around 3%. The current yield stands at 1.6%, nearly half of the historical average. Considering this, rating of 1. Moving on to the significant metric of shares outstanding, I am pleased to observe a substantial decrease in the number of outstanding shares. Intel has repurchased 18.9% of its shares over the past 10 years, amounting to a staggering $63 billion spent on share repurchases. Huge. However, it's worth noting that these repurchases stopped in 2022. Despite the negative impact on our 5 dimensions, it is evident that Intel is now entirely focused on reclaiming its dominant position and return to growth and profitability. I'm genuinely intrigued to witness how this strategy will unfold. As far as this metric is concerned, I'll give it a rating of 4. Now, it's time for the summary table with every 5D component. After analyzing each component of the 5 dimensions, we arrive at a horrible final rating of 1.70. Just look at those growth and profitability dimensions. Flat ones. Yikes. This is definitely a cause for concern. However, we must always look forward. The key to understanding this stock lies in Intel's strategic investments. We have observed a significant increase in operating expenses, resulting in a negative impact on profits, and the cutting on dividends and share buybacks. All of this is for one goal: investing billions of dollars to regain its competitive edge in microprocessor design and manufacturing. Despite the discouraging final rating, we should not jump to conclusions just yet. It's time to move on to our valuation sections and assess Intel's current valuation. But before we get to the juicy part, I need a favor from you. If you're having fun watching this video and learning something new, please show some love and support to the dude by doing these 4 simple things. Subscribe to the channel, smash that like button, ring that bell, and spread the word to your peeps. Okay dudes, we're ready to rock and roll with this DCF valuation. Upon analyzing the historical averages of our variables, it's challenging to find positive points. Revenue growth has declined by over 10% in the past 12 months and has plummeted by nearly 30% since its peak in 2021. Furthermore, cash flows are negative, and as such, so are the negative free cash flow margin and price to free cash flow multiple. Even Intel's previously notable stock buybacks have ceased, leading to dilutions of shareholders due to stock-based compensation for employees. It's difficult to envision a positive scenario based on these observations. However, we can find some encouraging news from Wall Street analysts. They anticipate a return to revenue growth in the coming year and expect Intel to regain profitability this year. Although an earnings per share of 0.42 is not remarkable and still significantly below the peak of 4.94 in 2020, it is a notable improvement compared to the current negative value of -0.70. Moreover, analysts project an EPS of 2.41 in 2025, almost 6 times the current year's expected EPS. While Intel still faces challenges ahead, This provides a glimmer of hope and a potential light at the end of the tunnel. But enough of talk, you all want to know my assumptions and the results. In my base case scenario, I believe Intel has the potential to close the gap with TSMC, AMD and generate strong returns on capital in the next decade. Intel's current investments and course of action support this belief. Furthermore, the CHIPS and Science Act signed into law in August 2022 is expected to provide subsidies for Intel's chipmaking facility construction and expansion. In this scenario, I project an average annual cash flow growth of 55% for the first 5 years and 5% per year for years 6 to 10. Although the growth rate for the first 5 years may seem high, it's important to note that my projection only anticipates Intel's free cash flow returning to the 2020 record of around $19 billion by 2032. This scenario essentially depicts Intel returning to what once was. I also assume a stock repurchase program with a 0.5% annual reduction rate on shares outstanding, a free cash flow margin of 19%, and a price to free cash flow multiple of 15x, which is lower than Intel's historical average. Based on these assumptions, I believe that Intel is significantly undervalued. We could potentially pay up to $43.81 for the stock to enjoy our 12% required rate of return, representing a 39.8% upside from the current price. On the other side, if our base case assumptions hold true, buying the stock at the current price could yield a yearly rate of return of 15.8%, which is a great outcome and above our required rate of return. It all seems too optimistic, but if everything goes right with Intel's investments to regain market dominance, I don't have the slightest of doubts that Intel will beat these numbers easily. Now, let's move on to the bull case scenario, where I will naturally have much more optimistic assumptions. If we believe these assumptions will materialize, we could pay up to $72.69 for the stock to have a 12% yearly rate of return. Considering the current price as $31.34, this represents a significant upside potential. The assumptions are not as far-fetched as they may seem. For instance, the projected free cash flow in 2032 would be $26.7 billion, 40% higher than the peak of $19 billion in 2020. Similarly, the projected revenue in 2032 is $107 billion, 35% higher than the peak of $79 billion in 2020. Again, if Intel has its manufacturing struggles figured out, I can easily see Intel beat these numbers. On the other hand, the bear case scenario suggests that we should pay only $17.81 for the stock to achieve a 12% yearly rate of return. This represents a downside of minus 43.2% from the current price. Buying the stock at the current price would yield a meager 3.9% internal rate of return. This internal rate of return accounts for cash returned to shareholders through dividends and stock repurchases and also for the share appreciation or depreciation. In this scenario, I consider that Intel won't be able to return not even near the historical profitability, projecting only a yearly cash flow of $9 billion and a revenue of $60 billion in 2032. A $60 billion revenue is practically the same revenue Intel had over the last 12 months. This is definitely a very conservative scenario that considers the scenario where Intel sees AMD and Nvidia becoming the new market leaders in the semiconductor space. Let's now explore the extreme cases. Starting with the extreme bull case, this scenario assumes that Intel reclaims its market leader position within the next 5 years, which I frankly find quite challenging. While I am optimistic about Intel's ability to generate excess returns over the next decade, I recognize that Intel's manufacturing inferiority to TSMC, AMD may persist for the next year or two. Nevertheless, we need to account for such unlikely scenarios. If this scenario comes true, Intel could generate outstanding yearly returns above 30%. And to achieve our required rate of return of 12%, we could pay up to $132.03 for the stock, which is 321.3% higher than the current price. Yes, dudes, Intel would need to execute perfectly in order this scenario to happen. But one thing caught my eye. Even in this optimistic scenario, Intel's market cap in 2032 would still be below Nvidia's current market cap of around $1 trillion. Which is madness. How is it possible to have such a huge difference in valuation between these companies? If Intel moves on to Analysis 2.0, I will absolutely go deep on this comparison between the two competitors. Lastly, we have the extreme bear case. In this scenario, I consider that Intel completely loses the semiconductor war to AMD, Nvidia, and Intel's customers who design their own ARM-based CPUs. Intel's cash flows are projected to be around $3 billion in 10 years, with revenues nearly halved compared to the current levels. As a result, Intel's stock price could crash by more than 80% to around $7 per share. It's definitely an ugly scenario, but we must account for it. Intel has fallen behind in recent years, and if their recent investments go sideways, it's one step closer to a scenario of this nature. Now, keep in mind that these assumptions are just a first gauge of Intel's valuation and don't incorporate qualitative information from more advanced analyses such as Analysis 2.0. Before making any investment decision, I would need to stress these assumptions. But for now, I hope this gives you a good idea of where Intel stands in terms of valuation. This is the summary table with all the scenarios' price targets and probabilities. The probabilities that I think best reflect the scenarios I made are 65% for base case, 18% for bull case, 16% for bear case, 0.5% for extreme bull case, and 0.5% for extreme bear case. Weighing these probabilities, the final price target for the stock have a 12% yearly return as $45.10, indicating an undervaluation of 43.9%. It's encouraging to see some positive data and potential upside for Intel, especially after the hideous picture highlighted in the 5 dimensions analysis. As you can see from the graph, Intel's stock is currently trading in fair value territory since June 2022. Maybe it's a great opportunity to buy the stock. What do you think, dudes? Let me know down in the comments. But our work isn't done yet. Let's delve into the multiple valuation method to confirm these initial results. To determine a fair price for a company, we need to compare its current multiple to its 5 and 10-year averages. When selecting the 10-year average as our comparison point, we obtain a price target of $30.44, 2.9% below the current price, which indicates that Intel's stock is fairly valued according to this approach. And now it's time to wrap up the first analysis of Intel's business by comparing the 3 different data points: 5 dimensions, DCF valuation, and multiple valuation. One of our missions for today was to assess the current state of Intel's business and it had what it takes to move on to analysis 2.0. We saw in the 5 dimensions a picture of an awful business. A final rating of 1.7 is just a nightmare. And yes, Intel has lost market share, conceded on pricing, and faced a sharp decline in gross margins and returns on invested capital. Moreover, threats from competitors such as AMD and x86 CPUs, ARM-based CPUs developed by Intel's customers, Nvidia's first-mover advantage in AI, and Intel's recent manufacturing struggles collectively impact the company's future prospects. However, it's important not to overlook the fact that Intel is currently undergoing a business transformation and diversifying its operations. The company is actively involved in initiatives related to the Internet of Things, artificial intelligence, automotive technology, and foundry services. These efforts could present additional growth opportunities for Intel in the future. Additionally, Intel's only competition for leading-edge semiconductor manufacturing is TSMC and Samsung. Semiconductor manufacturing is inherently capital-intensive and thus providing a reasonable moat as it requires methodical planning and execution to keep the cost per chip at a reasonable level. Taking all these factors into consideration, Intel's future prospects are shaped by a combination of challenges and potential growth opportunities. As the company continues its business transformation and explores new avenues for growth, the outcome remains uncertain. Ongoing analysis and monitoring of Intel's performance will be crucial in determining the company's trajectory in the ever-evolving semiconductor industry. The other mission was to assess Intel's valuation. In DCF valuation, we saw a severely undervalued business, a reflection of the uncertainty the market still perceives in Intel's business transformation. In multiple valuation, we saw a fairly valued business. Considering these findings, it is time for my final verdict. Intel will advance to the next round, Analysis 2.0. Although the 5 dimensions analysis revealed significant challenges and portrayed a rather unfavorable business outlook, there are intriguing aspects to consider. Intel's ongoing business transformation holds the potential for additional growth opportunities in the future. Furthermore, the significant undervaluation of Intel's stock in the base case scenario, where Intel just recaptures its historical cash flows over the next 10 years, could lead to stellar returns. If you can't wait for my second analysis of Intel stock, please consider subscribe to the channel, turn the bell on, hit the like button, and share with your friends and family. It would help the channel grow and reach more people that need to see this type of analysis. Together we can make a difference. Peace, dudes. You rock.